Glyn, August seemed like quite a benign month overall. What was going on under the surface?
Yes, it was actually quite a good month for risk assets generally in August. Volumes were very low. Interestingly, it's not unusual for this time of year. Of course, August is the prime Northern Hemisphere summer month, so a lot of people are away. Volumes were down and volatility was low, but it was generally quite a good month. And I think there were really two major issues that investors were focusing on. One was the state of the global economy, and there appears to be evidence now that there's some stabilization in growth levels, having seen that slide in activity levels in the first half of the year. And the second factor, without question by far the most important, were indications from the two big central banks, the Fed and the European Central Bank, that further monetary stimulus is on its way.
Before we move on to that, let's talk about the data first. Quite a lot out of the US.
Yes, the US actually, generally speaking, performed a little better than people were thinking. We saw industrial production numbers coming in at 0.6, a little better than people thought. Retail sales at 0.8 in July, quite a bit better than people thought. The GDP in Q2, the first estimate of growth was 1.5. It was revised up to 1.7. Not great numbers, obviously, but evidence of some stabilisation in this slide in activity, which was important. And then, interestingly, the employment numbers remain reasonably good, still at quite elevated levels at this stage in the cycle. Unemployment is still running at over 8%, but the numbers have been slightly falling, so a little bit better than people thought. But unemployment is still at a level where the Fed has concerns about it. And remember that the Fed has a mandate to ensure employment stability in the economy.
Aside from the US, much new news from Europe?
Yes, there was news from Europe on the economy. Most people, of course, expected Europe to show negative growth numbers. That was confirmed in the second quarter GDP numbers. The June quarter, the Eurozone GDP was down 0.2, no worse than people thought. Within that, there was some positive surprises. That the absolutely key German economy grew by 0.3%. The French economy, which people thought would go into recession, actually was flatlining. The real weakness in the Eurozone, quite inevitably, of course, was in the debt-ridden peripheral economies, which have been really struggling with their austerity programs. So we saw Italy contract by about 0.7%, Spain by about 0.4%. Greece, now into its fifth year, not fifth quarter of recession, was down by 6%, 6.2% to be precise. So the Eurozone is certainly in recession, but not quite as bad as people feared. I think that, again, that was not dissimilar to the US. Evidence that there was perhaps some stability in this slide in activity levels, which people took some comfort from. But let's not kid ourselves. The growth trajectory we're seeing from the developed world is very sluggish, and it's going to remain that way for quite a while. It's still going to be a tough period ahead, but that slide appears now to have stabilised to a degree. We're going to get choppiness, but it appears to have stabilised. The UK the same, incidentally. The UK GDP numbers, the first cut for the second quarter GDP was minus 0.7. It was revised up to minus 0.5. Not dissimilar to the US, interestingly, employment has actually been rising, unemployment going down in the UK, in contrast to what's been happening with the GDP numbers. So it's quite a dilemma that economists are wrestling with in the UK, but it looks to me as if the UK economy is essentially flatlining, sort of zero growth or thereabouts at the moment, with potentially some pickup in the second half.
Okay, let's move then to central banks. Obviously the big news from Europe. Before we move there, let's touch briefly on what's been going on in the US.
Yes, well the key event, I think, really in the month, as far as the US was concerned, was Bernanke's Jackson Hole speech, this annual conference and gathering they have at Jackson Hole only 10 days or so ago. It was an interesting speech from Bernanke because he spent some time analysing the costs and benefits over the past 5 years of non-traditional measures of quantitative easing monetary policy. Because remember, they've cut interest rates to virtually nothing. There's nothing else they can do as far as traditional measures of monetary policy are concerned. So he spent some time analysing the non-traditional measures and concluded that the benefits of that over the past 5 years materially outweigh the costs. And he went on to say that the Fed is prepared to engage in further non-traditional measures of policy accommodation, particularly if unemployment remains at these sort of 8% levels. The Fed regards unemployment as about 2 percentage points too high. So as long as unemployment remains at these sorts of levels, there's a very clear indication that the Fed is going to ease further. There's an important meeting coming up in mid-September of the Fed. It may be the last chance before the election in November for the Fed to engage in further easing, so we're watching out very carefully for that.
Okay, then let's look at Europe now. Draghi clearly taking centre stage in August, really.
Without a shadow of doubt. The whole tone for August was set in his late July speech in London, where he made that now quite famous comment that the ECB will do whatever it takes to preserve the euro. There was a further process right throughout August of Draghi softening up the markets, the members of the Eurozone and the Germans in particular, for further non-traditional monetary easing measures. So he talked about the irreversibility of the euro. He talked about the fact that if the ECB goes in the market to buy sovereign bonds of distressed companies, it will be within its mandate, and explained why it was within its mandate, because he made the point that effectively monetary transmission is being negatively affected by these very high bond yields. So he was softening up that whole process. The current position is that the ECB is meeting in 2 days' time on Thursday of this week, and there is an expectation that the ECB will make further announcements about secondary market purchases of sovereign debt of those distressed countries, but they will require those countries to actually seek a bailout from the Eurozone stability mechanisms, the EFSF and the ESM. So there will be conditionality attached to that, controls over fiscal deficit and so on and so forth. But it's now clear that everyone in the Eurozone accepts that the ECB will be moving in that direction. So absolutely key, all of that was during the course of the month, and the main factor that was driving markets.
Plenty of macro going on in the background. Then let's turn our attention to what's happened in the markets, perhaps the developed markets first.
Yes, it was a good month for developed markets. The MSCI World Index was up about 2.5%. The US and UK were up about 2% or so. But the big moves were in Europe. The peripheral markets in particular were very strong. Remember, they had been weak earlier on in the year, but we saw rises of sort of 9-10% in Italy, Spain, Greece, and generally Europe was the standout performer, because of course there was this feeling that the ECB is prepared to take this very serious action to at least buy more time for the Eurozone to overcome its problems. So it was a good month for developed equity markets. Yeah, bond markets also did actually quite well, but again concentrated mainly in the Eurozone. We saw falling yields, peripheral markets in particular, and I think that helped generally the overall bond index to produce a modestly positive return. Although in fact in the big safe haven markets, the US, UK, Germany, we actually saw a slight rise in yields. It was more the peripheral markets and actually in fact currency moves that helped that overall government bond index to move ahead slightly in the month.
Okay, emerging market equities struggling a bit more though.
They certainly did. Emerging market equities actually had quite a big underperformance against developed markets, down 0.3% for the month, the global index. I think the really important factor there is what is happening in China. Of course, by far the most important emerging market economy. And I think the market and investors generally now accept that we're seeing a very significant slowdown in activity in China. All the data coming out continue to confirm that. Purchasing manager indices were down again, slightly disappointing. I think it's now about the 7th month in a row of negative numbers. There was a very disappointing number in the month on exports, only up 1% year on year. So there's a recognition that China is slowing down. Big question, is it cyclical? Is it going to bounce back to that 8 to 10% level that we've become accustomed to over the past decade? Or is this a structural thing where we're going to see a slowdown more towards the 6-7%? We of course feel that we are seeing a structural slowdown in China, and I think that in part is being recognised in what is happening in emerging markets. So quite a disappointing performance in the month.
Okay, just by way of conclusion, looking forwards.
Well, I'll say one other thing on the course of the month, which I think is indicative of how things might pan out. It was interesting what happened to some commodity markets. We saw gold, having been really doing nothing for quite some time, up about 5% in the month, and I think that reflects the expectation of the markets that we're going to see further monetary stimulus, non-traditional measures of monetary stimulus. And of course that brings into question the value of sort of fiat currencies, conventional currencies. I think that was a useful indicator. And I think now there's quite a lot built into market expectations about what the ECB in a couple of days' time and then the Fed in 10 days or so are going to do at their next really important meetings. And I think there's a slight danger that there could be some disappointment. You know, travelling is often better than arriving. This expectation's been built up. There's going to be some pretty serious action. So the ECB now really does need to take some pretty serious action. So a little bit of room possibly for disappointment in the short term. And bear in mind, August was a good month. July wasn't a bad month. We've had quite a decent move now from those low levels of late June in markets. So I think some consolidation in markets is likely. But underpinning all of this, as we've said consistently over the course of this year, equity markets still offer pretty good value. Corporate earnings have been okay in this earnings reporting season. Yes, there's a slowdown that's gone on. We're aware of that. That's built into prices. So we're still looking for opportunities to add to our equity risk, particularly in developed markets, during periods of risk off. And for sure, we're going to get this risk on, risk off pattern. You know, we don't feel the need to chase markets. So I think it might be a little bit of a choppy month ahead. It's obviously a very, very important month as far as these big central bank meetings are concerned, and we're watching out carefully for that. But quite a lot built into short-term expectations.
Great. Thanks, Glenn.